Maruti Suzuki has fallen sharply from peak levels. And now the biggest question for investor is no longer what happened last quarter. The real question is far more important. Is this a rare chance to buy India's largest car company at better price, or is this exactly how value trap begins? Because many investors lose money in stock that look cheap. They see correction, compare it with old highs and assume opportunity. But price down does not automatically mean value up. Sometimes a stock falls because the business is temporarily under pressure. Sometimes it falls because future returns are weaker than people realize. And if you cannot tell the difference, you can trap your capital for years. This is analysis and not an advice. Let's begin with what makes Maruti attractive. First, scale. Maruti remains India's largest passenger vehicle player with unmatched distribution reach, service network, manufacturing ecosystem, and brand recall built over decades. Scale matters because it lowers cost per unit, strengthens supplier bargaining power, improves financing partnership, and creates customer trust that new entrants take years to build. Second, balance sheet quality and business resilience. Unlike many cyclical companies that depends on leverage, strong auto leaders survive downturns better because they have cash generations, brand strength, and pricing flexibility. Third, India's long-term car penetration story. India still has lower car ownership per thousand people than many developed countries, which means long-term demand can continue rising if income grows, road improves, and financing deepens. If you believe in India consumption story, auto remains one way to play it. Now the bullish case gets stronger if current pain is temporary. Recent pressure came from margin compression, raw material inflation, and weaker earning conversion. If this normalize, profit can recover faster than revenue growth alone suggests. This is why some investors get interested after corrections. They are not buying past quarter, they are buying normalized future earnings. But now comes the danger. Why could this be value trap? First, category shift. India's consumers are increasingly moving towards SUV, premium features, safety-led buying decision, and new preference. If market growth shifts faster than Maruti adapts, old strength became less powerful. Dominance in yesterday's segment does not guarantee dominance in tomorrow's segment. Second, EV transition risk. Even if EV adoption takes time, capital market price future disruption early. If investors believe competitors have strong EV positioning, valuation premiums can shift before actual market share shift. Third, margin structure. If competition intensifies and customers demand more feature at aggressive prices, profitability may not return to older level easily. A business can grow volume while earning lower returns. That matters hugely for valuation. Fourth, re-rating mathematics. Suppose a stock once traded at a premium because investors expected smooth growth, strong margins, and leadership certainty. If any of those assumptions weakens, the stock may deserve a lower multiple even if the company remains good. That means the stock can stay flat for years while earnings slowly catch up. This is the silent pain many investors underestimate. So, how should value investor think? Do not ask only whether Maruti is down from high. Ask five better questions. One, what earning growth can be company realistically deliver over next 3 to 5 years? Number second, can margins recover or are old margins gone? Third one, can Maruti defend relevance in SUV, premium products and EVs? Fourth, is the current valuation already discounting this risk? Fifth, compare with other opportunities. Is expected return attractive enough? That last question matters. A stock can be decent yet still not be the best use of capital. Now let's talk about scenarios. Bull case. Input cost cool, margin recover, launches improves, demand remains healthy, exports add support and valuation re-rates. In that case, current pessimism may look excessive. Bear case. Competition grows, margins stay weak, EV narrative shift elsewhere. Growth moderates and valuation stays compressed. In that case, the stock may look cheap but remain dead money. Base case solid company, moderate return, slower wealth creation than past cycles. That is often how mature leaders behave. Final verdict. Maruti is not automatically an opportunity and not automatically a trap. It is a classic case where business quality and stock returns can diverge. The company still has scale, trust, and structural strength. But investor must separate admiration for the business from expected return from the stock. In markets, buying a great company is easy. Buying it at price that creates wealth is the real skill. So the question is not has Maruti fallen? The real question is what future is already priced in and what future is still ignored. That is where value investing begins. Make sure you subscribe the channel, like the video. Thank you very much. See you in the next video.